Let me finish. So first of all, welcome. Thank you for being here in this fine evening. Today we'll look at this cool finance class, chapter 6. And yeah, so first of all, a little bit about me. I'm doing finance next year, master's in finance next year in Amsterdam. So you could say that I really like it and hopefully I'm good at it and good enough to teach it. I'm considered as an academic machine. And third of all, I'm an AC Milan enthusiast. I'm a big AC Milan diehard fan. So if there's any Inter fans out there, I don't like you. Anyway, no, that's not the right button. So how the structure works for Athena, we're first going to look at some theory of chapter 6, look at some examples, and hopefully at the end of the day, if you guys understand all the content, we look at some practice questions. I want to encourage you guys to ask as many questions as you can, because again, this is free. So you will never, ever get this opportunity ever again. And I'll answer it to the best of my abilities. I do ask you to have some patience. It is quite overwhelming to teach in front of 30, 40 students. Since I'm normally used to teaching 10, 15, but since this is my first free class, it is pretty overwhelming. So if I make a mistake or I stop at any point in time, just be patient and be kind. Because if you're kind to me, then I'll be kind to you, in the sense that I will teach to the best of my abilities. So, well, I think there's the QR code first. Yeah. So before starting the class, I recommend you guys to join the group chat. This is a QR code if you haven't already scanned it or joined the group or joined the WhatsApp group chat. This is where you guys could either ask me questions and I'll answer them as fast as possible, or the best case scenario is you guys create a little community where you guys help each other. I think that's really nice when you guys ask each other questions and help each other, because that's how we all thrive, helping each other. And if you guys understand something, you could explain it to someone else. So I'll give it some 30 seconds so you guys can scan. Okay, a lot of people joined. 3, 2, 1. Okay. So chapter 6, valuing bonds. I think the marketing manager asked in the year 1 group chat what was the most difficult chapter, and you guys said valuing bonds. So that's why I'm dedicating this whole hour on this chapter. So I will go in detail. I'm gonna break down some formulas, hopefully explain them part by part, so you guys could really. My goal is for you guys to not only understand the general topic, but also to understand why we apply each formula and how each formula is constructed, so that you guys can have the whole essence and the whole basis of bonds. So first of all, what is a bond? You could say that a bond is a lending agreement. So it's basically I lend you money and I get a certificate, and in the future I'm going to give back this certificate, so I get more money in the back in a few years when the bond term ends. So why are bonds important? You can say that they're the 3 points on why they are important, or the ones you guys need to understand. The first one is that the price of the risk. Free government bonds can be used to determine the risk-free rates. This is because in a government bond, you are expected to get your money back, yes or yes, because the risk of default is minimal, is non-existent, because you're guaranteed your money back. So the minimum incentive to lend them money, so like to give them to give you a reason for you to lend them money, would be that the teeny tiny incentive that carries no risk for you. So it is used to deduce the risk-free rate. Second of all, firms often issue bonds to fund their own investment. So there are 2 types of bond. There's government bonds, and then there's corporate bonds. Government bonds is when the government, so you could say the Dutch government, asks you for money, and yeah, you lend them. They issue those bonds. And there's the second one would be the corporate bonds, where it's actual companies where they're asking for you to lend them money, and they will give you. Normally, the corporate bonds have a higher return rate, because they have a little bit more of risk to lose it or to not guarantee you that money back. And third of all, bonds return will help us to determine the firm's cost of capital. So similar to the risk-free interest rate by using the government bonds, we can use the corporate bonds but to calculate the return rate of a firm. If there are any questions, just put in the chat, and I have it on my screen on top, so I can see them instantly. So just let me know. So before we dive into formulas and theories, let's go into some terminologies. The first one is the bond certificate, which is the information and all the characteristics of the bond you're taking. So it's basically all the terms that means for how long you're taking this bond for, how much money you're lending, how much money you're expected to receive in when the term ends, etc., etc. So it's all the information. Basically, the certificate, you have all the information there. That's referred as the bond certificate. Second of all is the maturity date. This is important to calculate N in all formulas. So this is like the final repayment date. So when you get your money back. So the money you lent plus the interest you get for lending the money. And third of all would be the term. This is like the time remaining until the repayment date. So yeah, pretty straightforward. I'm not expecting any questions. And if you have any questions, just say it. There are two types of bonds. The first one would be the zero coupon bond. Again, we're gonna go through both bonds in detail, so don't worry about that. Also, I put these Mike Wazowskis across the slides, and I'm gonna ask you guys in the end how many Mike Wazowskis I put. So that's like a test. If you know how many Mike Wazowskis there in the presentation, that means you paid attention. So that's one. Anyway, so what is a zero coupon bond? It's a zero coupon bond is a bond that does not pay any interest, but instead it is only traded at a discount. This means that it will be less. The value would be less when it is in the as the face value, so that will render a profit. This means that when you buy it, it will be cheaper than the actual money you receive in the end, and the difference between the face value and the present value, or like the price of the bond you're paying, will be your profit. And the second of all would be the bonds with coupon payments. The coupon payments can be said to be like an extra incentive to lend them money, because, for example, a zero coupon bond are for bonds that are risk-free. This means that, again, there is no risk of default, so you are guaranteed your money. Therefore, you don't need any extra incentive to lend the money. The only incentive you need is the risk-free rate. That's why we only there's no extra coupons, you know? But with the coupon payments, there is extra risk. Therefore, as an investor, you need a reason to lend the money, and that reason would be an extra a little bit more of a percentage of profit, which are stated as a coupon, right? And yeah, so basically, I think a really important thing to understand is that the higher the risk, the higher the yield. So the riskier bond it is expected to have a higher return, because, I mean, they're asking for your trust, you know, and a way to gain that trust would be saying, like, if you guys give me a lot of money, I know I'm asking for a lot, but if you guys lend me the money, I don't put it in the, sorry, I lost. Yeah, so again, let me restate. As a zero coupon bond, there is zero risk. There's zero risk to lend them money, and in the coupon, it's basically asking them, giving the investors a reason to invest their money on that bond instead of a risk-free bond. Hopefully that makes sense. And the exact definition is that bonds with coupon payments is a bond that pays interest on top of the yield to maturity. So you have the incentive of a risk-free coupon bond, and then the extra coupon payments would be the extra incentive. Now, more bond terminology for more bond terminology before we go into the calculations. The first one would be the face value. So the face value is the notional amount of the final repayment and maturity date. And cease your worries, because I also was very confused as to what notional is, because it's a very abstract term. And notional is basically the total amount of a securities asset. And also like the given value we give to a security and when we issue it. And we use that to compute the interest rate in the end. What is a coupon? The coupon is the promised interest payments. So again, as I explained it when I explained the two types of coupons, the two types of bonds, a coupon is an extra incentive for you to invest in that company or government because they need your money. And if you don't give them that extra, if they don't give you the extra incentive, then you won't invest because there's extra risk. So this coupon is a way to convince you to invest. Hopefully that makes sense. And the coupon is viewed as a coupon rate. So it's symbolized as a percentage rate and not an actual number. So the coupon rate is viewed as is expressed through APR. Hopefully you guys already know what APR is. So it's basically expressed through percentage rate annually. And the way we calculate this is by when they give us the coupon rate, we just multiply it by the face value, and depending on how many quarters, how many times a year they pay us, that will be divided by that number. So if it says coupon rate the coupon is 3% and we pay these coupons annually, then the number of coupon payments per year would just be 1. But if they say it's semi-annually, then it's 2. Quarterly, then it will be 4. So it really depends on what the question says. So that's why in the midterms, I really recommend you guys to really outline every important piece of information, because those keywords will really completely change your answer. So when it says semi-annually, make sure that you split the APR into 2, because then you do it twice a year. Okay. If there's no questions, are there any questions? I see no questions. Okay, I'll continue. Now, oh, it's bugging. Okay, now I have a question for you guys. Hopefully with my very detailed explanation, you guys can solve this. So it says a coupon bond has a face value of 1,000 and it makes quarterly coupon payments. The coupon rate is 10%. And what is the coupon payment? So using the formula I gave you guys in this last slide, I want you guys to calculate the coupon payment, the total coupon payment. So I'm going to give you some time, and whenever I see, let's say 5 to 10 people saying done, I'll move on. Okay, we got one by Dina. Dina is saying done. Okay, so I need 4 more, guys. More cooperation, chat. Okay, 4, 5, nice. So basically, by using the formula I gave you guys in the previous slide, we do, wait, let me copy paste it so you guys can, if you guys are not sure. Oh, no, I'm gonna screenshot real quick. There we go. So we use this formula in the end. So it says that the coupon rate here is 10%. We basically multiply 10% or 0.1 times the face value, which will give you 100, and you divide that by 4 because it says quarterly. This means that the coupon is given to the investor 4 times a year. Hope that is pretty clear, pretty straightforward. And if there's no more questions, I'll move on. No questions? Okay. Moving on. Now, the zero coupon bond. So now I gave the general terminologies, general knowledge. Now we're going to go into the 2 formulas that are pretty crucial for this chapter. And I remember when I was in my first year, I really did not understand the difference between the zero coupon bonds or the coupon bonds, especially the coupon bonds, because it's a 2-part formula. And I don't think it's the best or the best strategy to just memorize them, because I mean, you can memorize them, but it's not ideal because you don't learn. You need to understand why we're giving these, why the formula is like this, you know? So my aim of this is for you to understand why the formula stays like this, you know? So first of all, the zero coupon bond. This means that this bond will make no coupon payments throughout the year, throughout its term. And we calculate the price of the zero coupon bond through this formula. This formula should be familiar to you guys, since it's just basically finding the present value of any given number, you know? So basically we have the face value. It's the time value of money, basically, formula. So you have the face value and we need to retract it. We need to like go back in time with the yield to maturity rate through this formula. And we use the yield to maturity, which means that this is the internal rate of return of a zero coupon bond. And yeah, this is where we're basically discounting the face value from its with the discount rate. And the way we do this, okay, yeah, so we have some terminologies. Before moving on, we also have another formula besides the calculating the price of a zero coupon bond, which is the yield to maturity. And this could be either you can learn it or you can also figure it out through this formula itself. Thank you, Alexander. So you have this formula, right? And you can basically move it around for you to deduce and make yield to maturity the subject. So I can do it real quick so you guys can really grasp it. So you have PV, right? Equals, wait, let me move this. The face value 1 plus, I hope you guys understand my beautiful drawing. Yield to maturity to the power of n, right? So first we would move this bracket to the other side. So because in this side it's dividing, we're gonna pass it to the other side by multiplying. So you would do present value times 1 plus yield to maturity to the power of n equals the face value. If you guys realize, this also helps because it's basically adding the percentage to the present value, which will give you the face value. So it also works for the face value. But we don't want the face value. We want to figure out yield to maturity. So now we want to move the present value to the other side. So we leave yield to maturity on its own. So because here is multiplying, we're going to pass it to the other side, dividing. So this would be 1 plus yield to maturity to the power of n equals face value divided by present value, or the price, whichever fits you. Okay, now that we have this, we want to pass the to the power of n to the other side. And again, because here it's doing to the power of n, we're gonna inverse it. So it will be moving to the other side, it will be 1 over n. So it will become 1 plus yield to maturity equals the face value divided by present value to the power of 1 divided by n. And finally, because here the 1 is adding to the yield to maturity, we're going to pass it to the other side, subtracting. So it will give us, I'm not going to do it. It will give us this formula. So the reason I did this whole effort is because I never learned this formula because I found it really complicated to learn. I mean, now probably if I try to learn it, I can, but first year I couldn't. So I just understood why the formula was like that. It's just basically because we just reorder it from present value to making yield to maturity the subject. Hopefully that is clear. And if it's not, let me know in the chat. Anyway, moving on. Okay. Now, for the zero bond terminologies, the yield to maturity here is defined as the internal rate of return of a zero coupon bond, which is a single discount rate that it simply equates the present value of the bond's remaining cash flows to its current price, right? So essentially what a zero bond, a coupon bond does is telling you, so it's basically telling, the company is telling you, wait, where is the pen? Yeah. We are giving you $1,000 in the end. That's the value we're giving to our bond. So what do you need to pay? Is basically asking you, what do you guys need to lend us for me to give you $1,000 in the end, right? So to finally reach the end value. Face value is basically the end value of the bond. They're saying our end value at the end of the day will be valued as 1,000. Given that, let's say the yield to maturity is like 3%, you need to pay X. Let's do 1,000 divided by 1.03, right? In this case, it's saying investor A, let's say, needs to give us $970.87 for you to receive the end face value. And it can go either way around. So if you don't know if you know the present value and the face value, but you don't know the yield to maturity, we're asking how much percentage do you need, like, increase for you to reach the $1,000? If that makes sense. Hopefully that makes sense. I'm assuming it makes sense. And then it's basically the thing I explained right now is that the discount rate that sets the present value of the promised bond payments equal to the current market price of the bond. So essentially, they're saying that this is the face value, but the $970 that we use in this example is the market value, the current market value. And hypothetically, it should reach to 1,000 when the term ends, right? So your profit would be the percentage difference between 1,000 and 170, the yield to maturity. And that is without no extra incentive. This would be assumed as the risk-free rate because we're just giving the money and they are guaranteeing us that we will receive it back. So this is the bare minimum, the bare incentive for us to lend them such money. So normally the zero coupon bonds are done by governments or very like highly certified companies. So they have reputation and we know we're guaranteed our money. There's basically no risk, just the bare incentive. And then the formulas. So as I explained before, the price of a zero coupon bond can be explained by just discounting the face value with the year to maturity and the term of the bond. And as I mentioned before, this could be related to the time value of money because it's basically the same. It's just discounting the face value to the present. So we could even say that the risk-free rate could just be inflation adjusted, like it's just adjusting to inflation or a bit more of an incentive, So that's why it relates. We're just discounting it to its present value. We're just protecting us from inflation. And that's basically it. That's risk-free rate. So that's the bare minimum. Okay. There we go. Now with coupon bonds, there are two payments. Why? Why are there two payments? Because there's extra risk we're enduring by lending them money. So they give us the extra incentive through the coupon bonds, the coupons. In this case, there are two payments. The first one would be the face value at maturity date. So again, it's just the profit we're gaining from the first part would be the present value, the difference between the face value and the present value of the bond. And that's our profit. So let's say bond A is worth $9 and it says that in 3 years, it's going to be worth $12. This is it. This is your profit, $3. Or as well, it can also be expressed through percentage, and it will give you like 33%. That's the what's it called? The return rate, risk-free return rate. Okay. Oh my God. Okay. And then the second payment we expect from the coupon bond are the coupon bonds that are given at regular intervals. This is expressed in APR, so it is given annually, but then depending on how many times it is given periodically, we calculate it on how we used it on the example before. So this formula is expressed in the following way. So it's basically the coupon payment we calculate by multiplying the coupon rate times the face value. divided by the yield to maturity. And then we just do 1 minus 1 divided by 1 plus yield to maturity to the power of n, plus the face value divided by 1 plus y to the power of n. Now, this is really complicated. No, I spoke for like 3 minutes just doing this formula. And now we're going to break it down. So we can say that this formula is divided into 2 parts. So the part 1, which is like the simpler one, let me clear, would be this part, right? This is the exact same formula as a zero coupon bond. It's just this. It's just basically discounting the face value to the present. That's it. That's the risk-free rate. That's what we get for just lending them money and no risk. But because these bonds do have a risk, they are expressed, the extra money or the extra interest we're receiving is expressed through this part, through the coupon payments, right? So this is exact same thing as the zero coupon bond. Zero coupon bond, right? And then this is the extra incentive for lending them money and not investing in a risk-free bond, you know? And of course, as an investor, as a rational investor, it really depends on our taste, you know? Like, are we really risk averse and just invest in the safe investments, or do we like the extra risk so we can get a bit more than we would get if I just invest in a normal one? So this is made for riskier investors that just don't want their money guaranteed, like don't really mind the extra risk for a bit more of a extra return. Now, hopefully, the second part, when I say second part, I refer to the interest part. The interest part reminds you of another formula. Oh, yeah, okay, so I explained this, that it's divided into 2. But this formula, this part of the coupon payment, should remind you of another formula. And if you guys know it, you can put in the chat. If not, I'll continue in 3 seconds. If you want to participate, you can always participate in the chat or by unmuting yourself. But I'm assuming no one will. So I'll review the answer. And it says, yes, very good, Dina. It's the annuity formula. Isn't that so crazy? So what does the annuity formula mean? It's basically receiving constant cash flows for a fixed amount of time, right? So we are receiving a constant amount of coupons throughout the term of the whole bond. And we're basically calculating the present value of those cash flows. And that would be the coupon payments. And then the second part would be discounting the face value to its present time, right? So it's 2 different calculations. So first, you have the present value of the bond, which is also given for a zero coupon bond. And then you have the second part, which is the annuities of the coupons, right? And then when we're calculating the n, because the coupon bond is expressed through annuities, right? Through APR, we can either transform the number of terms into like the quantities, like the periods we're giving the money, we're receiving the money. So for example, if it says quarterly and we're trying to calculate the coupon months in 1 year, n would be 4. Either that or we turn y into APR divided by 4. So you can either turn the percentage into according to the period or the n according to the period, if that makes sense. So as I said before, the second part of the formula, or the first, is the same as a zero coupon bond. We're just trying to figure out how much the price of a bond needs to be for when the term ends, so we can have the yield that we were promised, the yield to maturity. So essentially, the coupon bond is a combination of annuities. So that would be the constant cash flows we're receiving from the coupons and the present value of the face value when we're giving the maturity, the yield to maturity. Again, remember that the coupon, because I remember first year they don't really explain what the coupon means. You know, it's just like I thought it was like a coupon, like those discount codes. You know, and didn't make sense. But if you understand a coupon as an extra incentive to invest in this bond, so it's just giving you a reason to invest in such in such bond, in the either corporate or government bond, I feel like it makes more sense, like why there's a difference between there's a difference between the two bonds, because I felt like they didn't really explain both really well. They just told you, oh, there's just two types of bonds. I mean, hopefully it changed this year, but 2 years ago, they would just tell me that this is a thing and you just need to learn it. But I feel like it would make more sense if you know what the coupon means. So it's just the extra incentive for investing in this. What does eternal happiness mean? I still don't know. I'm trying to figure it out. But I'm just saying that if you understand this formula, you're able to achieve eternal happiness because you understand and you're able to pass your exam. That's what I mean. So there's no finance terminology about the eternal happiness part. Oh, I don't know what happened here. Now, I put this picture because this should be you after understanding the difference between the two coupon bonds. Hopefully. And if there's any questions, don't forget to tell me, ask in the chat, and I'll answer you. It can even be private, by the way, and I'll just say in the chat so it can be anonymous. If it's too scary to put it in the public chat. If there's no questions for the annuities or the zero coupon bonds and the coupon bonds, I'll move on. I'm gonna wait 2 seconds. Nothing. Okay. Anyway, now bond prices. So there are 3 ways bonds can sell in. The first one will be a discount. This is when the price of like the current market price of the bond, so how it's currently traded at, is lower than the face value, or that you could say that the face value is bigger than the current price of the bond. Also, it's also when the yield to maturity is bigger than the coupon rate. This can be very confusing, right? Again, first year, they just gave me these rules and they just told me learn it. But don't you worry, I have a video. I sent it yesterday in the group chat, in the first year group chat. But hopefully this tutor will make you understand the difference, like why when it's a discount, the face value is lower than, no, the face value is bigger than the price and vice versa. And then the second way a bond can sell at would be at par. This is where both conditions are equal. So this would be when price equals the face value and when the coupon rate is equal to the yield to maturity. And lastly, it is when it's sold as a premium. This means that the current market price of the bond, like the price it's currently trading at, is bigger than the face value, and also when the coupon rate is bigger than the yield to maturity. Okay, and I think it's really important to mention that as interest rates rise, bonds prices will fall. So from these conditions, you can understand this correlation. Again, don't you worry, I have a very cool video. Before this, I'm just going to explain that once the bond is issued by the company, so let's say Amazon, little Jeff Bezos. I'm gonna draw Jeff Bezos here. This is Jeff Bezos. Jeff issues a bond of $100, right? He needs money for Amazon. He says $100. So he issues it to the public market. And let's say that investor A in the primary market, so there's 2 types of market. The primary market is investor A, right? This is where like all the institutional investors buys the bond. After this bond has been bought by investor A, so this is investor A, it goes into the secondary market. This means that this investor A, now that he owns this bond, he can also sell it in the secondary market. And that's where like demand and supply really determines the price of the bond. So this means that even though the face value of the bond is $100, it can fluctuate once it reaches the secondary market. This will make more sense in the video. I'll put it. Right. There you go.
What is the yield of a bond?
Can someone say in the chat if you can hear the video? I'll restart it. Yes. Okay.
What is the yield of a bond? While reading up on bonds, Mudra has come to know that the actual yield of a bond may be different from the coupon rate it offers. He wonders how that could be so. He decides to visit a financial advisor to investigate the matter. Mudra learns that the coupon rate, also called the nominal yield of a bond, is simply the predetermined interest rate that the bond issuer offers to investors. It is calculated as a percentage of the face value of a bond. Mudra wants to buy a bond with a face value of Rs 1,000 and a coupon rate of 9%. He would receive an interest payment of Rs 90 every year on his bond. Coupon rate or nominal yield is equal to annual interest payment divided by the face value of the bond. But since bonds are bought and sold in the secondary market, the market price of Mudra's bond is likely to fluctuate and be different from its face value. In such a scenario, the rate of return on Mudra's bond would be different from the coupon rate. This rate of return is known as the current yield. Current yield is equal to annual interest payment divided by the current market price of the bond. If the market price of the bond Mudra wants to buy falls to Rs 900, Mudra continues to receive the same Rs 90 that the bond issuer had promised at the time of issue. So Mudra's current yield would be 90 divided by 900. That is 10%. Mudra figures out that when the price of a bond goes down, the yield goes up and vice versa. Now that he understands returns on bonds better, Mudra finds himself better placed to decide his investments in bonds. Points to remember. The coupon rate of a bond may differ from its current yield. Coupon rate or nominal yield is equal to annual interest payment divided by the face value of the bond. Current yield is equal to annual interest payment divided by the current market price of the bond. The yield of a bond is inversely related to its price.
Okay. Hopefully, oh,
Commodity futures. Mudra.
we don't want to learn about commodity futures. Going back to the video. Hopefully that was completely understood. And now you're a very knowledgeable person with bond prices, right? Are there any questions before I continue?
Oh, I have a small question.
Yeah. Oh my God, you scared me.
So in the video, it says that the bond and the price of the bond is like the yield of the bond and the price of the bond is inversely related to each other, right? But the yield means that what the investor is expected to return.
Yeah.
So when the price gets lower of the bond, you are able to expect more in return.
Mm-hmm.
Oh, I thought
Yeah.
that. Can you explain why?
Yeah. So basically, it's just you're calculating the difference between both. So the present value of your bond and the difference between the present value of the bond and the face value is your profit. So if it's selling at a discount, so a very high discount, this means that eventually it will, when it reaches the end term, you will make more profit. So it's bad when it's selling at a premium, if that makes sense. But because it's selling at a premium, so the yield to maturity is very low, right? You are expected to get more incentivized. So like you're expected to trade off that yield to maturity with a higher coupon rate. So you get a higher when it's selling at a premium, because that's bad. So we don't want this, because that's the current market price is that's basically saying that the coupon is overpriced. And the way we trade off this is by giving you a bigger interest rate. So the lower the price of the bond, so let's say 30, and if the face value is 70, your profit is this percentage difference, or even like the actual amount, so 40.
Okay, I understand.
Yeah.
The terminology was not like matching in my head, but now I understand. Thank you.
Right. No worries. Okay. Question time. Now we're gonna related to the question Alexander asked, we're gonna figure out the yield to maturity for each the price for each year. Okay. So again, this is an example. So when we want to calculate the yield to maturity of a bond of 1 year, we're gonna just plot the numbers. So we put the face value on top, the actual current market price of a bond in the first year. So it will be 98.04 to the power of 1 because it's just for 1 year, and minus 1, so we get 2%. So we're using this formula. Where is it? Where's the pen? This formula right here. This formula. So if you guys can do it for each year, that would be insanely amazing. Well, let me see if no, okay, they do the answers. I can see here. So I'll give you guys 5 minutes to do this. And yeah, just tell me done. So when I reach 5 to 10 people saying done, I'll move on. Actually, no, we're 45 people. So once around 10 people say done, I'll move on. 10 to 15. Also, Samuel asked if I find this exam easy. It is pretty easy, but I do think that it's less enjoyable than the final exam because these are just general terms, like finance terms, and not the ones that are fun. It's just like you have to learn these, and they're not really entertaining, I would say. So that's why when I did it, I found it more difficult than the final because, yeah, since it was my first time touching finance, there's a lot of new terminologies, and like new formulas to learn. But in the second semester, or like the second part of the semester, you'll see that the formulas you're learning now can be applied in other in like better formulas, like better concepts you're gonna learn later on, and that's way more fun. So I think it's not that it's difficult, it's just not fun, so it makes it difficult. But there's not a lot of math. Okay, Erwan is done. Matthias is done. Do we get these formulas in the exam? I do think so. At the back of the exam, there's a formula list, and I think it includes the perpetuity formula, annuity formula, and the coupon bond thing. You should see it on your canvas. In your canvas, it should be a tab there, and it says like formula list, and that will be in the exam. So like at least first semester, like first half of the semester, there's not a lot of like formulas to learn because they will be given to you. Okay, so I'm being said that only perpetuity and annuity and growing. Okay, so no coupon bond. So that is necessary to learn. Hopefully, with my amazing explanation, you guys can understand the coupon bond because it's basically combining the annuity formula with just discounting the face value formula. Okay, I see a lot of dones. Okay, so by using these numbers, right, you just plot it's basically just plotting it in the formula because since I gave it to you guys, you should get these, right? If no questions, I'll move on. So now that we have these numbers, we can do something really, really cool, which is plotting them in a graph. And there's nothing more fun than putting points in a graph. And with these, you can see how the relationship between short-term and long-term in when it comes to bonds. Okay, so as you can see, the higher the more time passes by, the higher the yield to maturity will be. And a question that was, I also taught this last year, like so I've been, I guess, up to date from the first year from like the syllabus from 2 years ago and the year before. So I'm assuming it will stay the same. There will always be a question about the economy on how the yield curve will like basically predicts a recession. I don't know if this is the case, but just in case, I decided to put it there. So basically, when the short term the short-term yield to maturity is lower than the long-term, this means that you have a stable economy. Okay, now why? I will explain. Do we get the PowerPoint after? Yes, you do. Great. So basically, how do we predict a recession with the yield curve? So as I said, when it's the lower the term of maturity and the lower the yield, this means that you have a good economy, right? But when it's the inverse, so this means when there's a higher yield to maturity when it's short term. So let's say this is 1 and this is 5. So when you invest in a bond of 5 years, you will only get very low percentage, like 2%. And when you invest in a 1-year coupon bond, you get like, this is insane, like 15%, that's a lot. This means it's a bad economy. Now I'm gonna explain why. Wait, let me read this. Okay, so when people buy treasury bills, they're basically providing the government with funds. Again, the government needs money, and they're asking you, they're basically begging you for money, and this is viewed through investing in bonds. Okay, what they say is that they will repay you after a certain amount of time, right? This time is shown through the maturity date of the bond. And so an incentive for them to lend them money is seen through the rate of loan interest, right? Also known as the coupon rate. So in this case, by lending money to the federal government, which is like the top dog, there is a bigger risk when you give them money for a longer period of time, because like you're giving them the responsibility to take care of your money for such a long time, so obviously the more time you have, the more time there is for uncertainty. We don't like uncertainty because we don't know if there's an earthquake could happen, another recession could happen, they could just lose your money. So you're better off just investing in 1 year, so you're like basically reducing the probabilities of something bad happening, right? So this is in a good economy, right? So you're not expected to have a lot of return rate when you invest in short term, because there's no risk. In a year time, very little can happen. So you're guaranteed your money back. So this is why the yield to maturity will be very low. However, when you give them the money for a bigger what's it called? Like a bigger, no, not a bigger, a larger part of time? No, a longer a longer part of time, you're giving them a higher responsibility. So there's a higher risk that something bad could happen in a span of 5 years, 10 years. So this is why there is a bigger risk when it comes to long term, right? However, the inverse applies when there is a recession. So every time the yield curve inverses, we say that there's a predicted recession. So when I say that there's an inverse yield curve, this means that the shorter the term of the maturity, the higher the yield, like the higher return you will have. This is because investors are worried about the short-term economic growth. When there's a incoming recession, so in the next 2-3 years, you don't want to give them that, like you don't want to endure that much risk. So this means that the yield will rise because investors will look at a longer term for bonds because of the uncertainty and the risk that the stock market is enduring during the short term. So in this case, it's certain that there's a recession in the next few years. So we don't want to invest in short-term bonds because it's very probable that the government will not have that money to give you back in like 2-3 years if we think that there's a recession coming on. However, in 10-15 years after the recession has passed, we're guaranteed our money back. So once we predict that the economy will stabilize in the long term, we will get our money back eventually. So that's why when there's a recession incoming, we expect a higher risk, therefore a higher return, because we need, again, an incentive to invest. If there's no reason for us to invest in a risky bond, then why would we invest? There's no rational investor unless you like gambling. We don't want to do that. Okay, if you like gambling, then that's cool, but if not, then rationally you don't want that. You want the less risk possible, and if there's a higher return, then you're just gonna go with the least risk possible. I think a main takeaway for this class should be basically incentive. I think I've said the word incentive about 1,000 times because that's how you are able to grasp and understand all the concepts in the bonds. It's basically determining the yield to maturity, the term date, everything, because it's all based on incentive, you know? So you need an extra incentive to invest in a riskier bond or vice versa. And risk, of course, like incentive and risk. Okay. This is the end of the knowledge or the content I got for chapter 6. So now that we learned all of this, with the two main formulas we learned, I want you guys to apply your knowledge in the following, I think is like 3-4 questions. And yeah, just let me know if you have any other questions or anything that I missed that I did not prepare, but I could explain it really quick. If there's something I missed, just let me know. But without further ado, we'll move on to the questions. Oh, I double clicked again. Okay, chapter 6. Yeah, I said 15 minutes, but I mean, if you guys give me the duns, I'll move on quicker. Okay, so the following table summarizes prices of various default-free zero coupon bonds, which are expressed as a percentage rate of the face values. So it's a two-part question. Compute the yield to maturity for each bond. So again, it's basically repeating the same question, but this time, wait, before you guys, oh no, don't want to, I'm gonna delete the, so I removed the formula so you guys cannot just plot and you actually figure it out yourselves. So just do A, and B, I'll just show, because I mean, you're not expected to plot the graph in the exam. It's just for you guys to see how it works, but just do part A. S'il vous plaît. Also, guys, in one of the slides, I'm gonna put a QR code for an evaluation form. This is insanely important. Okay, wait, Shayana is done. Because this is basically my evaluation. So you cannot grade me on how I taught. And basically, if I get graded good, I get my rightful compensation. But if I'm a very shit teacher and I should not work for Athena anymore, you guys could also portray all your angers. But of course, I'd rather you portray your positive comments. But it really helps me and Athena out if you guys could evaluate me. And you can either go to the Athena portal or the QR code I'll show. And yeah, it really helps me out. I see a bunch of duns. I see 1, 2, 3, 4. So I need one more done. Okay. Cool. So is again plotting the formula. Remember, if you do not remember this formula, the yield to maturity, oh my God, the yield to maturity formula, this one, you can always deduce it yourself. And I explained how. And this is, by the way, this is by when the formula says this, you just do 1 minus, like -1. Don't forget that you can deduce, figure out this formula by just reordering the price of a bond. Okay, so essentially, that what really helped me, because at first semester there's so many formulas to learn and so many concepts to grasp that you cannot panic, because like you're expected to learn all these formulas. So what I did is just learned the price of a coupon bond, and from there on in the exam, if they ask me for yield to maturity, I would just write the face value, the price of a bond formula, and then just reorder it in the exam. because then it's less storage, like you don't have to memorize that much and you can figure it out on your own during the exam. And then when we're plotting this, it should be like this. This is the good yield curve. This is the non-recession, non-panic economy we want. And the inverse yield curve is when we're predicted a recession. Okay, don't forget that because that might be in the exam. Question 2. If the yield of a bond exceeds the bond's coupon rate, does it trade at a premium, discount, or par? Yes, William. So so face value is basically the money you will get at the very end. And the profit, you need to figure out on how much you buy it for in the present. So yeah, you're right. You guys can answer in the chat, by the way, because it's like a multiple choice type question. Okay. They're saying discount. It will be so embarrassing if it's premium. Okay, let's see. It's a discount. Boom. So if the yield curve of a bond exceeds the bond coupon rate, it is trading at a discount. So there's two conditions for this, and you guys could see either or, like it will always apply both, but like if you don't, if they only show you the coupon rate and the yield to maturity, or just the price and the face value, both conditions meet. So when the price is selling less than the face value, it's a discount. And when the coupon rate is lower than the yield to maturity, it's discount as well. A good way to remember this is that a coupon rate, basically the definition is the extra incentive, okay? Remember that. Coupon rate, the definition for that is the extra incentive. And because we have a higher profit because the way we calculate the profit is by doing face value minus the current price of the discount. So obviously the lower the you're buying it for, the more profit you'll make. So this means like there's more money, so there's no reason to give you a higher percentage of a coupon. So it makes sense that the higher profit you make, the less incentive you need to invest in such bond. So that's why the coupon rate will like go down. Okay. Beautiful drawings. Okay, I'm supposed to say question 3. But in this example, there's a 30-year bond with an annual coupon payment. Okay, annual. That's important. A face value of $100, a coupon rate of 3%, and the yield to maturity of 5%. Does this bond sell at a premium, par, or discount? So a quick hint, you need to obviously calculate the price of the... Okay. No. I'm going to change the question because you can figure it out without doing the question. So I'm just going to figure out the price of the bond. And then does this bond sell at a premium, discount? Okay. So you guys can practice the formula and not just... Done? Okay, Shayana is done. If Shayana, could you like also message me directly the answer? So I know that either I made a mistake or the other way around. So we need to see. We should compare answers. Let's see. Okay, so I have two dones. I need a bit more. Aha, found it. Okay, three. Okay, one, two, three. Nice. Got a lot of duns. Wait, I'm just gonna. Yeah, okay. Doesn't matter. Okay, so there's two conflicting answers here. So, I guess someone told me that the price was 23, okay, and someone else told me 69.26. Both of you are right because I'm assuming that my question was very abstract in general. So it will be correct. 23 would be correct if we would be just calculating the present value of the discount of the face value, right? Oh my god, I keep creating a text. Here's the answer. So the formula we're using for this question would be the coupon bond, right? So this formula, again, we're dividing it into two. So what when you say that it's 23, you are calculating this. This would be if it was a zero coupon bond, right? So yeah, naturally it will be 23.12138, which is really cheap, again, because it's in 30 years. So of course it's cheap. And then the extra incentive, because there's high risk, there's a 3% coupon rate. This is like the extra incentive you're receiving, apart from just the risk-free rate. So you add both and you should get 69.25. So yes, it is trading at a discount in the secondary market. Hopefully that makes a lot of sense and we can move on. If it doesn't make sense, you can either direct message me or message me after class. Okay, there's a mess here. Okay, so now we're giving this table, right, of percentages. And first, the first question is, what is the price today of a 2-year security with the face value of $1,000 and an annual coupon rate of 6%? Does this bond trade at a discount, at a par, or at a premium? Now, for this question, guys, because I also got confused because I did them and I got confused. Imagine the percentage, like the yield to maturity is fluctuating. Okay, so it's not like a stable percentage. Because, for example, like what anyone would think, like I don't know if it's part of the question bank or whatever, but I thought that for a 2-year bond, this would be the yield to maturity for sure, but it's not. No, it starts from one for at 4%, and once it reaches 2%, the second year it would be 4.3. So you need to calculate it periodically. So each coupon on its own. Okay, so for example, how can I explain this without saying the answer? Okay, I'll let you guys solve it. With just remember it's fluctuating, right? So you need to calculate each coupon separately and the face value separately as well. And then we'll discuss. Because it is a bit confusing. So again, 5 duns. I got two dones. Okay, I just need two more dones, guys. And then we can move on. Okay, perfect. Moving on. Okay, so when I said fluctuating, this means like for each coupon, there will be a designated yield to maturity. It's difficult to explain, but look, I'll explain in a drawing. So we're in this question, we're drawing when you receive like this table, it's basically drawing you a timeline. Okay, so for first year, the yield to maturity was 4%, and then second year it changed to 4.3%. So a way to understand this is understanding the timeline of a bond. So once you issue a bond, right, and you buy it for the present value, so X, let's say, and let's say that the term in this case is 2 years, right? So the way this works, okay, and an annual coupon rate. We're gonna use this example, right? So this is the face value is $1,000 for 2 years, $1,000, and we're buying it at X price. The way this works is that you buy it, Pepito, let's say Pepito bought it, and then first year, because it's annual coupon rate, he receives coupon. Boom. First year, he receives a coupon. Second year, he receives another coupon. Okay, so another coupon plus the face value, plus whatever he bought it for. Right? Does that make sense? So the price of the thing discounted. Yeah. So the face value, he receives the face value. So that's how a coupon works. You buy it, and then you receive your coupons periodically, and then at the very end, so the end term, you receive your last coupon plus the face value of the promised face value you receive from the coupon. So when I showed this answer, it makes sense. So we drew a timeline, right? So it's saying we're using the coupon bond formula, but we're like dissecting it into a timeline. So here, for example, in this answer, it is saying that we receive one coupon bond, which is 60. We do 60 because it was how much percent? 6%? Yeah, 6% coupon rate. So what we do is 1,000 times 6%, right? So 1,000 times 6% times 0.06. That's the coupon rate. So first year, this is the first year. That's why N would be 1 here. We receive this bad boy in a year. So we want to figure out the price of this in this case, this coupon at the time we're buying it. So the present value. So that's where we're going back in time 1 year, right? So this will be the first coupon. Now the second coupon we receive would be in the second year. So we'll be using this yield to maturity plus the face value that was promised at the end of the maturity date. And we're using the yield to maturity for 2 years. And because we want to go back in time, because we don't care about in the future, we care about now, how much I'm paying now, we're just gonna we're retracting it 2 years. So to the power of 2. Hopefully that makes sense. So if I drew this on a timeline, right? Let's see here. This is year 0. In year 1, you're receiving $60. In year 2, you're receiving another $60 plus the promised face value of 1,000. So we could say that in the future, your bond or whatever you earn will be 1,060, 1,120. But we don't care about that. We care about how much you're paying now. So we retract this to the like over there, to the present. Hopefully that makes sense because it took me a while to understand. And because it's higher than the face value, it is trading at a premium, right? Make sense? Okay. And also the coupon rate will be higher than the yield to maturity. Moving on. We only have time for let's see. Okay, well, we'll figure it out. Now B, What is the maturity of a security with annual coupon payments, a yield to maturity of 4%, and why? Now we're here. This is not a thing I taught because it's mixing content from chapter 2 or 3 with chapter 6. So if you haven't revised those chapters, you wouldn't know. And it's a very kind of difficult term to grasp. It's about, I'm gonna give you a hint, is about selling different securities worth the same with the same risk, but selling at different prices. So it's basically taking an advantage without incurring any extra risk. That's the hint I'm giving. Again, I'll wait for the duns. Again, reminder, please, after this class, go to your Athena portal and please evaluate me. You will also receive an email and I'll show a QR code soon. Because I already went overtime, so a lot of like 10 people left. They're probably in a rush. But please, 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 that really helped me. If you enjoyed my class or hate even, please let me know in the evaluation form because that's how I improve. And either I can improve or get fired. So it's your decision. Like the fate is in your hands. So please evaluate me. It's really important. I'm waiting for the dons as well, by the way. So if you're done, just let me know. And sorry for going overtime. Hopefully I'm not taking your time. Okay, it says a lot of people don't know how to compute that. Okay. Let me check before I say something stupid. Okay, so here, there's basically nothing to compute. Because, so it says, what is the maturity of a security with annual coupon payments and yield to maturity of 4%? And why? Okay. Okay, it's pretty straightforward. So, here it's essentially saying because of arbitrage, and based on the this is like the market rate of all the bonds, it would be 1 year. Let me go back to the question because I need to explain it with the question. Wait. Okay, so I'm gonna like screenshot this bad boy and put it here. Okay. Oh, that's not what I wanted. Okay, one more time. What the flip? No. What did I do? Okay, like this. Okay. So it says, what is the maturity of a security with the annual coupon payments and yield to maturity of 4%? So it's here it's saying 4%, right? So we just basically refer back to the table and it would just be one table, one year. Why is this? Because of arbitrage. So the essence of arbitrage is that if you could get a higher yield somewhere else for the same exact risk, same exact everything is basically same bonds, but are giving you different yields, then obviously there's an opportunity, you can leverage this and just basically buy this one and sell it in the one that we're selling at a higher percentage. And essentially in a perfect market, we're assuming that all bonds are of the same exact risk, same maturity, are trading at the same yield, because or else it would be an arbitrage opportunity where I could basically take advantage of a situation without incurring an extra risk. Of course, this happens in an imperfect market, so where we live in, but since we're working under perfect conditions, this is the assumption we take, that in a market, an asset, in this case a bond is an asset that has the same risk, same term, same everything, same value. It cannot go for different prices, because then it will be an arbitrage opportunity where again I'm profiting something. I'm profiting from something without incurring extra risk. Okay, hopefully that makes sense. So essentially, in an arbitrage opportunity, I could buy at the same exact security at a cheaper price and sell it at a higher price in the other market. Okay, so we don't want that, because then there's a lot of profiting. So essentially, in a perfect market, if security A and security B are the same, they have to trade at the same price. Make sense? Hopefully that makes sense. Yes. Thank you, Nathan. Moving on. Okay, so wait, I'm gonna leave this question for you guys to do, because I really want to do this question, because this will be in the exam, since it's using the coupon bond, and I think it's really important. So yeah, this is the final question I'm gonna be showing, and the last question C, letter C. Please do it on your own time, and if you have any questions, I'll answer in the chat. But I really want to cover this one because it's important. Again, if you guys say done, I'll move on, and I'll stop yapping. God, it's so creepy. Okay, I see one done. Two done. I need more. I need 3 more. Okay. I'm good with 3. Okay, one more. So I'm gonna confirm with 4 dones and then I'll move on. I don't know if you're saying the name Don or you're saying Don. Also, if you guys like my SpongeBob, make sure to evaluate me. If that's like saying I like your SpongeBob, so I'm evaluating you. Okay, thank you. Oh, this is an ad time. This is again the evaluation form. So if you could take a picture, I won't take more time because I don't. This is annoying, but take a picture or look at your Athena portal. It's very important because that's how I get compensated, or else I'm gonna either get fired or like get good money. Okay, thank you. I'll move on. Okay, so how do we do this? My SpongeBob is blocking the answer. So, in the exam, I recommend you to, whenever you see like a coupon, like the word coupon, and you know that it is involving those formulas, I involve you to put it in the answer, like to just write the formula, because most of the time, you'll figure out that like there's so many formulas that you don't know which one to use, because in this case, you need to reorder stuff, right? So I recommend you to either like put this coupon bond one, the discount rate one, and then figure out what elements they're including, so that if you have all of them, you can include it in this formula. So in this case, you put this in the exam. Hypothetically, you're like, oh shit, it's saying like it's saying the coupon bond, so I'm gonna plot the formula, and then I'm gonna see what I have. So here it's telling me I have what do I have here? I have the face value of 1,100. I'm gonna download the presentation and send it in the group chat. Okay, so the face value is 1,100, right? So we have that. We have this. We have face value. So we plot it there. We have the yield to maturity is 5%. Boom, 5% here. Done. Plotted. Coupon. The coupon is trading, blah, blah, blah. Doesn't say. Okay, so we don't have coupon, but it is trading at 1,000. So this means that the price where it's trading at in the secondary market, currently it's trading at 1,000. So we have P. So we literally have everything. We have literally everything to solve CPN, which is like the coupon, the value of the coupon bond. Okay, so by plotting everything, all those numbers inside in the formula, you should get. I don't even know what's the answer here. So confusing. I don't think they give the answer. I can do it, but I'm pretty sure they do give the answer. Wait. Oh, they don't give the answer. How do I know if I'm selling where so it's so one of your colleagues asked, how do I know if I'm selling in a primary market or a secondary market? When it's just selling, when you're buying it, you're just assuming it's a secondary market. Okay, so it's always trading at a secondary market. So if it was trading at the primary market, it would just be like, not like, I don't know how to say it, but it's I just mentioned the secondary market part so you guys can understand why the prices fluctuate over time. And it just doesn't say it doesn't say the price is this, the price is that. No, it fluctuates with time, based on supply and demand. So don't really worry about the secondary market part, but it's just for you to understand why the change, the market price changes, because the value of a bond is what the company is issuing it at. But then after it is issued, it is the investors that give the price, that the relative price of it. Hope that makes sense. So don't worry about the primary or secondary market. That's just for like extra information that you don't need to know. So we're gonna plot the formula. Okay, so 1,000. So this is what you bought it for. C, we don't know C, but we do know yield to maturity, which is 0.05 times 1 minus 1.05 to the power of, where is it? 5 years. So 5. There you go. Plus the face value, which is 1,100. 1.05 to the power of 5. Now, this is really complicated. So what I would do here What would I do here to simplify it? I'm saying. So basically, these two are these are multiplying, right? So what you could essentially just do, since this is like C is multiplying by all of this, you just move this part to the other part by dividing it. Okay, but to simplify it, you can just calculate how much this is, and then this number you divide it by 1,000. You do 1,000 divided by that number. So you do 1 minus 1 over 1.05 to the power of 5. Oh, wait. No, never mind. Oh, I'm so sorry. It says yellow is not visible. Let's restart, guys. With black. Okay, so we're plotting the formula. Okay, again. It says, we already did this part. So we already plotted all the numbers we had in this. Like, it was really unnecessary for me to do it in yellow. It's right here, right? So now we went from 1,000 and we divided by, Fred, let me figure this out, because like the steps are, we do this, wait. 1,000 plus. Okay, so bed mass is a bit iffy. Which part goes first? Okay. I think it's easier. It's bed mass. Holy shit. Okay. We're confusing. It's confusing because it's a lot of brackets and like negatives and stuff like that. So minus what? Yeah, right? Because I'm also confused. Okay, let's forget about the solution because there's a lot of errors in those papers, and let's do it ourselves. 0.05, right? Times minus. Okay, we got it, boys. We got it. It's just bed mass is complicated. Okay, so we basically here it's adding, right? So because this is adding, we're moving it to the other side by subtracting. So we do 1,000 minus 1,100 divided by 1.05 to the power of 5. Since these are multiplying, it would be like this, right? It's bed mass. Bed mass would be multiplication first. So we move this part to the other side by subtracting it, and then once you have this alone, so you have this equals to C divided by 0.05 times 1 minus 1.05 to the power of 5. And then once you have this, because this is multiplying, you can move it to the other side by dividing. Okay? So you do 1,000. So the numerator, you do 1,000 minus 1,100 divided by 1.05 to the power of 5. And then in the denominator, you do 1 minus 1 divided by 1.05 to the power of 5. Okay? That should give you 638.05. And then finally, in conclusion, you still have this, and then you just pass by the 0.05 to the other side. So you do whatever you got, 638 times 0.05, and you should get, I'm so embarrassed to say the answer because what if I got it wrong? But it's 31.90. Should be. That should be the right answer. Yes, I got praises. W's in the chat, please. Yeah, so that's basically it for today. I hope you guys enjoyed this free Athena session. I very much enjoyed it. And if you guys have any questions, just let me know in the group chat. I'll answer them. And please, if you guys have if you guys know an answer for a question someone's having in the group chat, help each other out, because that's how we thrive, you know. It's not like we do better if someone does worse, you know, it's just you do the same. So it doesn't really hurt to help someone out, and also helps you by explaining. Like I could say that I learned the best by teaching it. So yeah, that'll be